Hi guys, welcome along. I hope you are all well. Now, what I want to go over with you today is just an entry in the market, which you can take whether you are trading in any different asset or pair or anything like that. This is just entries in the market to help simplify what you are looking to do, as a trader. Because the end goal as a trader is very, very simple. It's not to crack the algorithm. It's not to understand all of the different meanings behind why this blue candle is blue and why this darker candle is dark. It's got nothing to do with any of that. I don't care about all these fancy indicators. I don't care about the footprint behind the orders that are inside here. I don't care about anything. I just care about performance in the market with the strategy I use, which is very, very, in my eyes, simple and easy to execute. The only thing a lot of you struggle with is just doing it and putting the executions to practice. Now, I've pulled out a completely random pair here today, and I'm going to show you an entry that you could be looking to capitalize on based on the same methods I teach week in, week out in the mentorship sessions. So this is a daily time frame. Now, the idea behind your ideal setups is that you want to be in line with the daily trading range. So if we are bullish, you want to be looking to trade in direction with that particular time frame. Okay. If you are bearish, as in coming lower, you want to be trading in direction with that time frame, and you want to do it realistically on the daily time frame, because the daily time frame is going to give you the volume that you need. And it's also a good measure if you are able to make a decision every single day on what direction you want to go in. You have to stick to that decision, and you have to understand that maybe once or twice you are going to be wrong. But if you can identify that you're in a bullish range all the way here, clearly looking to probably target that area of liquidity, and you're looking for lower time frame price action before you actually enter. And if you were to guess bullish on all of these days, even if you got it wrong a couple of times, let's say you got it wrong on two of the days in here, but you got it right on 5 of the days, well, with regards to risk reward, you're still going to be up. Let's say you took a couple of losses when price was dropping lower, and then you took a loss in here because you were guessing it was going to go bullish. But out of maybe 20 different attempts, 20 different trading days, maybe you've got it wrong 8 times. Maybe you got it wrong 50% of the time. Maybe you got it wrong, 11 times, and you got it right 9 times. But if you're looking for a minimum risk reward of 1 to 2, you still make money. That's the beautiful thing about trading. Trading, for me, is the true meaning of freedom, because there is nothing else you have to do other than master the charts. You're not answering to anyone. There's no client. There's no customer. There's nothing else other than you against the charts. Now, the charts could always prove to be an enemy when you let it become an enemy. But we have to look for the right opportunities within here. And if we go to yesterday and we look at yesterday's candle, which is this one here, we need to understand, how can we be buyers in the market inside here? And the answer is very, very simple. It's down to key levels of interest. So if price is clearly pushing higher, the only thing I am looking for is areas on a higher time frame which I could potentially look for price action to come back into, to give me some sort of signal that price is looking to move higher. That is my strategy. That is what I look for. I look for the same thing to happen again. I look for it to happen in the London session. I look for it to happen in the New York session. So are we in line with the higher time frame? This is the higher time frame. Yes. Are we in line with time and price? Yes. Do we have the right entries? Well, we're going to obviously have a look. So to show you on a chart format, because a lot of people, I think, get this wrong as well, because a lot of people look at this on a daily time frame and they try to think, right, well, I have to wait for price because I'm going to measure this entire range. And actually, I'm going to wait for price to come all the way down here before I actually look to buy again. But let's just look at the facts. We've been very, very bullish. The DXY has been very, very, bearish, bullish as well, sorry, which is why we're looking to go bullish with this. And you can see here from this clearly heading towards this area of liquidity. So once it sweeps this area of liquidity, it's not really my problem what it does, because we would have had our target achieved. If you don't see a pair, if you don't see anything that makes sense on here, go over to another pair. Go and look for something that has a clear target of liquidity and a clear sense of direction. If you do not know the direction, you are guessing. So when we look at this particular candle, and I just want to kind of zoom in on it, you can see that price made a low and a high and came down and finished higher than what it opened. So that's an open, low, high, close, bullish day. And if you look at what price did, it came into this daily fair value gap. That's a buy side imbalance, sell side inefficiency. And you can see that price action came into that area and then pushed higher. Now, I'm not pressing buy when price comes into here. This is what I'm looking for. This is just a key level. Price could come all the way down to here and then give me a buy move. If price doesn't give me a buy move, it's likely. So if price just carried on pushing lower, it's not going to give me a buy opportunity, which means I'm just not going to take a trade. But if price comes into here and then starts pushing to the upside on a smaller time frame, then I'm looking for some sort of fair value gap or some sort of order block to get myself in on, to target the next level of liquidity, or to target a 1 to 2 or something like that. But I'm utilizing the higher timeframes as my key level of interest. So as you can see, price has come all the way down. Now, again, we can examine this and see, price obviously came down. It not only swept, because you can see here, this is a 4-hour area of imbalance, and it's actually a bigger area of imbalance now, but we're still looking at the daily imbalance. But also, we now have liquidity in the market. So we've been sweeping below a lot of liquidity in the market here before pushing to the upside. Now, there's a couple of things you can do. You can see here already, if you're a swing trader, once price comes down to here, this is in the London session, 9 a.m. UK time, you can see price engulfed this entire down candle here. That's now a valid order block. And then you can see price came back down, retested before pushing to the upside. In theory, with price coming all the way back down now, you've got a potential live entry on a 4-hour time frame. You could set this, forget it, and walk away, get on with your week. Because price action has given us that move, on top of the range and things like that. Now, there's an easier way to get involved and a better way to get involved, and I'm going to show you. But we're looking at these areas of interest. And again, I think a lot of people make the mistake of identifying the 4-hour range and seeing that this is obviously the discount optimal trade entry level area. Now, optimal trade entry level areas, like this here being an optimal trade entry level, that for me, I don't like using these levels as areas of interest. I like using the OTE level area as an entry. It's called optimal trade entry. It's where the optimal place to take a trade entry is formed. It's literally what it is. That's it. There's nothing deeper. Okay. So as we can see, price obviously isn't coming all the way. It just wants to tap into that area of imbalance, and then it's obviously pushing higher. But now I'm looking at, higher time frame, lower time frame. I'm going to see, right, I'm not interested in that OTE level area. I can see that price action came all the way lower during the London session, made a low, and then created a huge bullish move to the upside, to the point where we broke this market structure. Okay. Price then comes back, retests this fair value gap right here. Not only does it retest that entire fair value gap, it obviously marches towards this particular high. Okay, that's all you need. You need to look at it from here to there. If we look to measure this trading range now, suddenly you have an optimal trade entry level area. That is what I utilize my OTE levels for. So looking at when that was formed, it was formed at this entry came in the New York session. The London session created low of the day. Price action pushed itself higher to the upside. In doing that, we came back into the range. We swept all this Asian liquidity. We came into a daily point of interest level area, and then price came back down, broke market structure, came down into the optimal trade entry level. If you entered at the optimal trade entry level and you just targeted this level of liquidity right here, you've got a 2-to-1 risk reward trade, which means if you put £1,000 on this on £100,000 account, you've earned yourself £2,000 on this one move. Now, a lot of you aren't becoming successful with these types of setups because I'm guessing you're sitting here on really small time frames. You're not understanding what these particular ranges are. Nothing looks particularly bullish about that. It just looks like it's clearly bearish. And then when price does push to the upside, it's not coming back down into what I'm guessing is the fair value gap you're actually looking to try and target for an entry. I'm not saying you can't be successful, by the way, on the smaller time frames. You absolutely can. And I absolutely have become successful on the smaller time frames. But what I'm saying to you is there's an easier way. Okay. There's an easier way for us to do it. And that is by just focusing on extra evidence inside our key levels. That is it. Extra evidence inside our key levels. And you're not going to win this every single time, by the way. Like you're just not. This isn't going to win. This isn't going to be an outcome that gives you 100% win rate. You know, this is an outcome which I believe will provide you with freedom to live the life and do what you want. But you have to understand you need to adjust to the emotional side of things. Let's say you're on a 15-minute time frame, and this is coming in at 2 o'clock. So this is the London session. That's the imbalance. That's the optimal trade entry level area. Let's say you actually missed this entry. Well, you can see price has obviously expanded to the upside, and it has now come back and retested this order block right here. So once again, you've got another chance on a smaller time frame, in fact, to enter. Now, because there's no imbalance lower down, you're not actually going to be, this isn't like an optimal trade entry level, but here's the trick when it comes to measuring optimal trade entry levels. This is the wick, and this is the top wick here. Now, that wick is very, very large. Okay, that's a large wick. Now, what you have to understand about wicks is they are gaps in price. And this could be a false reading because this wick has already happened with time and price. We've had a news release, and that's the push, and then it's pushed higher. So this wick realistically should not be considered a threat to you. This is actually protection. When we shouldn't come lower than it. We shouldn't really come lower than this body. In fact, we shouldn't really come lower than this wick here. So if you entered here, you could have your stop loss under this wick here. We shouldn't come here. If price action actually travels lower than this wick and starts coming down to here, then your stop loss is getting taken out anyway. So you might as well crack on with a higher risk reward trade setup. But this is what people are looking at measuring their ranges from. When in actual fact, you need to measure from when the volatility kicks in. So if you look at when the volatility actually kicked in, you can see here, actually, that's more of a normal optimal trade level. It's at the 61.8%. You could even be a little bit more sort of subjective and measure the bodies, but you'd still see there that price comes down to the 50% and then pushes higher, but you're inside a higher time level of imbalance. Okay, so this is an entry. Not only have we got that, we've got a breaker block. So this is a unicorn model. We spoke about these levels before. Okay, so it's a unicorn model where you could be looking to enter in. So again, you could have entered anywhere inside here. You could have had your stop loss here, and you could have got potentially just under a 1-to-1. If you held it all the way up to here, you could have had a 1.5. If you held it to its highest point, you could have got a 2-to-1. But realistically, we never got the trade set up in terms of risk reward but the real move was down here. Okay, the real move was down here. That was the position you wanted to put yourself in, because this particular trade here, entering off the OTE level inside an area of imbalance, just targeting that next high, gives you absolutely everything you need. Before, there's really nothing else to consider. There's nothing else to consider. If you held it to its highest point, somehow you've got a 5-1. But you don't have to go to the smaller time frames to find the ultimate success when it comes to trading. I actually think this is a lot less stressful for you. We're still looking to trade inside the New York session or inside the London session. It just means I'm not too busy homing in on the smaller time frames, seeing what's what. I don't like really, at the moment, I wouldn't really advise going any lower than the 5-minute time frame when you're looking to actually take these setups. Taking entries off this wick here on that order block is risky, because you just don't know what you're doing yet. And if someone ever comes out and says, "Oh, I took this trade here, and that was my stop loss, and that was my thing there, I got a 10-1," I feel sorry for people that fall for that. I generally feel sorry for people that fall for that. You're not going to find many brokers which are going to give you two pip spread, let alone. So most people would be taken out on that, especially if you've got higher amounts of capital. You've got to be sensible when you approach this. And this is just a random pair, by the way, guys. And what we've basically done we've broken down this entire setup right from utilizing point of interest in a daily time frame. You don't have to go with the daily time frame every single time. And you can clearly see here, price action decided to sweep above yesterday's high. So that, what we did today is we swept above that liquidity. And then on a smaller time frame, you can see once we swept above that level there, price action came all the way down. We engulfed this entire candle. That now is a valid order block. We've swept this particular level of liquidity. We've disrespected that level of imbalance. We've violated that. That's now an inverse fair value gap. That's basically price telling us it's not looking to respect this level. So that there clarifies that as an inverse fair value gap. Some people take entries off that. But again, price action came up to here today inside the New York session. So, was there potential for some sort of opportunity inside there? Because you can see here, this is the engulfing candle. Price action comes into this area here at 3 o'clock and then breaks to the downside and gives us another potential fair value gap, which you could be looking to enter inside of. So you could have been a seller here with your stop loss above here, targeting this liquidity here. And you'd have been in line with what is happening on the daily time frame. And it'd be interesting to see actually where we are in relation, because this is another good trick. I'm going to utilize this here. This here is 4 a.m. Now, 4 a.m. is subjective. It's midnight, New York. And basically, the way I do it, the way I simplify things with this, and I'm just going to find this one as well, because this is going to make things so much more easy to understand. This is being recorded, by the way. And let me just draw it for you. Now, if you are not sure in what direction, price is going to go in, and you can see there's a perfect looking entry for a sell, you should measure out midnight New York time. Okay, you should measure out midnight New York time. Let's just say it's here, for example, because the highest probable sells are going to happen above opening price. The highest probable buys are going to happen below opening price. So if you get to the New York session and you're looking to enter in here and you see price starting to sell off from here, and you can see that you're actually above opening price, that is going to give you the extra piece of confidence you need before you enter a setup. And if you happen to be below it when you're looking for a move, you can understand as well, right, I'm below opening price. Ideally, I need to be looking for buys. And yesterday's opening price was right here. And all of this action was going on under the opening price during the New York session. That makes it higher in probability. And then we fast forward to today, And this entire move was happening above the opening price. So this particular move was higher in probability. Okay. That is what you have to start getting used to understanding. That is what you have to start looking for. So higher time frame point of interest, liquidity sweeps, daily fair value gaps, 4-hour fair value gaps, lower time frame signals and moves, engulfing candles, okay, change in the state of delivery, fair value gaps, optimal trade entry level areas. You can identify those areas, and you also identify whether you are above or below opening price. That is going to give you so much more clarity with regards, to the actual entry. You can see here this entire range that was created came right back into the optimal trade entry level above the opening price. So once again, that particular trade there, straight up to 71%, and then it breaks lower. That's not random. It's not random that it happens at that particular time. It's not random that, this was created here and then price broke lower. This is what you just have to get used to trying to look for. This is my bread and butter. Is there more confluence as we look forward to make it easier for ourselves? Yes. But do you need to understand that when you're at the beginning of your training career? No. This is enough for you to go by right now. Hopefully you guys found this insightful. I'm going to close this and open up a Q&A, but hopefully you found it insightful, and I will see you all on the next one.